Richard, US companies who are struggling obviously have the option for Chapter 11. Is it time for a European Chapter 11?
Well, of course, the one thing people forget is that any company can file for Chapter 11. You only have to have a minimum level of assets in the US jurisdiction, and you can file. So you could ask the question whether it's actually never ever necessary to have a European Chapter 11. A lot of countries in Europe do have a sophisticated insolvency regime. Most of the countries are party to the UN Model Convention on Insolvency, and there is a high level of recognition of insolvency proceedings across Europe. I'm not sure that the Chapter 11 style for the Europe is entirely akin to the way the countries in Europe actually see life. They are probably obviously Chapter 11 is a debtor-led proceeding where the company's management is left in place. I'm not sure that they would necessarily see that on an indefinite basis that would be seen as a good idea, as opposed to potentially having more independent management. These insolvency regimes move over time, and it's not unlikely, but whether it's necessary and whether it's appropriate for all industries remains to be seen.
Does the following ring true with you? Last year we had a mini rally in offshore mid-year. More outlandish ideas raised more money and invested more capital in a sector already suffering an excess of capital, and the banks continued to pretend things could only get better when in fact they were clearly getting worse.
I think it's important to remember how decisions and credit decisions and how investment decisions are taken. Banks, do not look to put capital out there on an indiscriminate basis. They receive details from owners of changes in the market that they think will mean that a project is successful. They can probably give ideas from charterers and other industry participants of a desire and need for that infrastructure, and they will only base that lending decision on that and an understanding of where that capital is going to be paid for. Looking at it akin to the industrial sector, this is very similar to what happened in 2009 with eco bulkers, where with a very low charter rate, owners did come up and said, our customers are saying we want to have more efficient vessels in order to pay for high fuel costs, and that was a very meaningful discussion to be raised with the banks, and banks were willing to take it because they were being offered a charter rate that looked as if it was sustainable. Within a few years, we have IMO 2020 looking completely differently at how bunkers are being used, and as a result, that decision wasn't necessarily so good. But I don't think anyone can blame the banks for those decisions. They only look at what is put in front of them, and they do so in a very thorough and measured way. So sometimes it doesn't always work.
When you reflect on your caseload in this sector, what types of themes currently dominate, and what kind of resolves are you finding?
The themes we have is that, at present we have a situation of very little new financing in sectors like offshore, in tankers currently. But what we find is that there's, for one sector that's out of the money, there is another sector that's in the money. So as a result, in a balanced situation, having a diversity is a good thing. And I think that applies to owners as much as others. I mean, you do get some people who are in the offshore business who have other interests in other sectors of the marine life, and that does help to sort of balance this out. But certainly in offshore, we do have to you have to be aware of where the market is, so that you do need to have the expertise in both restructuring and unfortunately enforcement, as well as writing new business. And you need to be looking at one case, how it can evolve within those three areas, and also where other people can help you. So, we obviously have colleagues in corporate and tax, competition, which is obviously very important when you have mergers and acquisitions and consolidation, about whether that breaches competition rules. And it's important to be able to have those expertise and skill sets to bring forward, to actually see how one case that may be today just a performing loan could actually end up moving into either restructuring, insolvency, or consolidation.
You mentioned the dearth of financing. Are you finding that you're fielding more inquiries from new sources of financing?
Yeah, we certainly do, and certainly again, with akin to the industrial sector, you do find different sources coming in. I mean, in the last 2-3 years, where what we've seen a lot filling in the gap of traditional debt financing have been private equity funds who've been setting themselves up as direct lending funds. So they will raise a pot of cash, say 500 million, specifically to be lent out, as a senior debt lender, or in some cases mezzanine debt. And so that's been useful. Also, again, private equity driven, you do find ones looking at different sectors, particularly those that can give a high level of return. Now, obviously, if you could say that lending money at sort of 8, 9, 10% above LIBOR is a case that is almost maybe destined to fail. So as a result, a lending decision of that nature clearly has to be very closely based on what do you intend to do with the asset, how will you work it, or an understanding of what the burn rate within the company is likely to be, whether they can get substantially paid before a problem arises.
Will this be the year that we finally see the start of the slow rationalisation needed?
By the sounds of this conference, which if I may say, Edwin, has been absolutely fantastic. I think you're absolutely right. I think a market of 400 owners with only 1 to 6 ships, representing 70% of the market, is probably unsustainable. Therefore, you do need to see consolidation of a type. And one thing I was interested to hear from the conference floor was the possibility of more pooling. Now, that could be a way of allowing owners to step back somewhat from the emotional thing, particularly with a family-run company, of they can still own vessels, but they're not involved in operation. And pooling has been widely used in the industrial shipping sector as a way of managing costs, improving your interface with charterers, because you can offer far more capacity in the markets that the charterers require. And I'd like to think that might be a good answer for some of those owners. Now, clearly, some of them may not survive, but it would be a good way if you could build up, say, 100 vessels, in a pool company, possibly run by one or more of the existing owners, or possibly using third-party managers like Anglo-Eastern or V Group, who we've heard from today, which I think would be a way of actually allowing a transition, for some of these companies who've been brilliant operators and who no one has ever had any argument that they've actually performed to the very highest technical and ethical standards.
You're a first-time attendee of the conference. We are midway through day 2. How have you found it?
It's been absolutely amazing. The quality of the speakers and the attendees. Sometimes conferences can be a little bit variable in terms of attendance, but you can see here you have very senior people who are very engaged, and the quality of the questions that have been coming has been absolutely first-rate. So, I definitely will be coming again.
Thank you very much indeed.